In this video, we're going to talk about Lucid Motors. If you're considering buying Lucid Motors shares in your portfolio, then please keep watching this video until the end, because it covers many of the factors that should be considered regarding buying, holding, or selling the shares. During the most recent trading session, the stock opened at $28.12 and closed at $27.02. The lowest point at which it fell to was $26.68, and the highest point it rose to was $28.19. Compared to the current price action, its 52-week low was $9.60 and the 52-week high was $64.86. The current trading volume of Lucid Motors is 9.1 million shares, compared to the average volume of 13.7 million shares. There are two main reasons why the volume is currently lower. On one hand, the trading volume during summer is generally lower than other periods of the year. The second reason may have something to do with the lawsuit that is going on at the moment. Several law firms are gearing up for class action lawsuits against Cciv for shareholders losing more than $100,000. Let's take a look at the difference between the company's market cap and the enterprise value. Basically, the market cap is the sum of the price of all shares publicly traded, and the enterprise value is the value of the company's assets when debts are paid off. We can see that the market cap of the company is $7 billion, and the enterprise value is $7.2 billion. It's quite interesting to see that the enterprise value of Lucid is lower than the market cap. Generally speaking, this means that the market fears what hasn't been appeared in the books, such as lawsuits, general sentiment regarding electric vehicles, and so on. On the other hand, it may be a significant opportunity for those of us who want to get in the stock while it's still cheap. Of course, the question is always, can it get cheaper still? That is the question we have to answer for ourselves. Personally, I believe that in the grand scheme of things, Lucid is currently at a relatively cheap price level for what the company may achieve and its place within the industry. Now, let's talk about the number of shares the company currently has and the shareholder composition as of the latest data. The total number of shares outstanding is 207 million shares. Among the total float, insiders hold 0% of them. We should also look at the percentage of shares owned by institutional investors. In that case, institutional investors hold 9.37% of the total amounts outstanding. There are also 34.3 million shares currently being shorted, representing 13.3% of the shares traded. The shares composition of CCIV is for the most part retail, meaning that those who chose to buy Lucid shares were convinced that the stock was going to take over the world back in early 2021. Meanwhile, it's interesting to see that institutional investors are only moderately involved within the company, which does say a lot about the company's outlook with professional eyes. In a way, it's not that surprising, considering that questions began to flow as soon as CCIV was confirmed to be merging with Lucid, regarding its value, its capacity to scale up, and how it's going to compete against other giants in the sector. With all that being said, the fact that most people holding CCIV are retail does mean that the stock's volatility is relatively higher. In the long run, I would like to see more institutional participation. That, of course, remains to be seen. Its price patterns shows that the company is recovering from previous bottoms, and since late May, it has been able to bounce back from the $9 level and never look back. Of course, the current recovery is fragile, but my personal opinion is that it's going to hold its current levels no matter what, while waiting for the next catalysts. My recommendation for the stock is to keep a moderate-sized position to benefit from the rising tide. The last element to consider would be the overall market sentiment in the financial market. The current reality is that investors and money managers are not willing to follow companies blindly, unlike much of 2020. There are many reasons why investors are now shying away from innovative and disruptive stocks. Some will say that they were overpriced, or that they were overbought, or that they were just relying on selling dreams instead of having solid financials. But the real answer is probably a simpler one. At one point, some investors began to lock in their profits, which created a significant crash in some companies' prices. Not because those companies are bad, but they just have more sellers than buyers. That triggered a torrent of sell-offs from February of this year onward to nowadays. The overall tendency at the moment is that those stocks are now bottoming out or have been recovering for some time, but investors are generally speaking more skeptical and on the sidelines, and only the companies with robust financials or ideas will survive the long term. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.